In a significant update from the coffee giant, Starbucks recently revealed preliminary results that underscore a troubling trend: a continued decline in sales. This decline marks the third consecutive quarter of falling same-store sales, raising serious concerns about the company's growth trajectory under the new leadership of CEO Bryan. During a recent earnings announcement, the company disclosed that its net sales fell by 3%, totaling $9.1 billion, and the adjusted earnings per share came in at just 80 cents. Analysts had anticipated earnings of $1.03 per share, and revenue of $9.38 billion, indicating a noticeable shortfall from expectations. The drop in sales can be attributed largely to a staggering 10% decline in customer traffic in North America. This downturn reflects a broader issue within the company, as the same-store sales in the U.S. dropped by 6%. Compounding these challenges, Starbucks reported a shocking 14% decrease in same-store sales in China, its second-largest market. The company noted that increased competition, particularly from local rivals like Luckin Coffee, has significantly altered consumer behavior in that region, further complicating its recovery efforts. In response to these challenges, Nikon has announced a strategic pivot aimed at revitalizing the brand through a new initiative, dubbed the Back to Starbucks Plan. In his statements, Nikon emphasized the urgency of fundamentally changing the company's approach to return to growth. Details of this strategic overhaul are expected to be elaborated upon during the company's upcoming earnings call scheduled for October 30th. Interestingly, even amidst these dismal results, Starbucks took a bold step to raise its quarterly dividend from 57 cents to 61 cents per share. CFO Rachel Ruggeri explained this decision as a means to instill confidence among investors, while the company navigates its turnaround strategy. The decision to suspend the fiscal 2025 outlook further underscores the uncertainties Starbucks is currently facing, particularly following a recent CEO transition. Under Nicol's leadership, the company is focused on enhancing its U.S. operations, where it has seen a decline in casual customers opting for more budget-friendly choices over premium drinks. This shift in consumer behavior has been particularly pronounced since the pandemic, as economic pressures have prompted many to reconsider discretionary spending on specialty coffee. In an effort to breathe new life into the company, Nicole has initiated a reshuffling of the executive team, including the hiring of Tressie Lieberman, a former Chipotle executive, as the new Global Chief Brand Officer. Additionally, the company is prioritizing key areas of improvement, such as enhancing the barista experience, morning service, café ambiance, and overall branding efforts. Despite these challenges, it is worth noting that Starbucks shares have increased by 1% this year, maintaining a market cap of over $109 billion. However, the recent after-hours trading saw a 6% decline in the stock price following the release of these preliminary results. As we look ahead, the forthcoming earnings call on October 30th will be crucial for investors seeking insight into how Starbucks plans to address these ongoing challenges and position itself for future growth. This developing story highlights the significant hurdles facing one of the world's most recognizable brands as it attempts to adapt to a rapidly changing market landscape. Stay subscribed for more videos.